The ASX 200 just posted its biggest weekly gain since 2022, up 4.4%, and yet the RBA is now expected to raise rates again in May. Those two facts should not coexist. A rallying market normally implies easing pressure, but this week's rebound was driven entirely by one event, a fragile 2-week ceasefire between the US and Iran. The relief was real, but it was borrowed against a structural problem that didn't go away. The Iran conflict began February 28th. Within days, oil surged above $100 a barrel. West Texas Intermediate peaked near $118 before retreating, and as of Thursday, it sat at 97.87. That level sounds like a comeback, but it is still nearly 40% above where oil traded before the war. The energy shock fed directly into services inflation, which was already running at a pace Australia's central bank couldn't ignore. The RBA had cut rates 3 times in 2025. By February of this year, it reversed course entirely. Now markets are pricing in 56 basis points of additional hikes by November, meaning the cash rate could reach 4.65% or higher. NAB raised fixed home loan rates again this week. Westpac told borrowers the economy does not care about their feelings. The ceasefire gave markets a reason to rally, but it did not give the RBA a reason to stop tightening. Oil remains elevated. Services inflation remains above target, and the government is still spending at its highest share of GDP since the Second World War. If the ceasefire holds and oil slides back toward $80, the RBA's next move becomes genuinely uncertain. Rate hike expectations would reprice, mortgage relief would arrive, and consumer confidence could stabilize. But if the Strait of Hormuz remains partially blocked, Iranian traffic is still restricted despite the truce, energy prices will stay elevated, and the May hike becomes almost certain.
The rate story has a second chapter that markets haven't fully priced yet. Jeffrey Gundlach, founder of Double Line Capital, one of the world's largest fixed income managers, issued a warning this week. The debt issued by small and mid-sized companies during the near-zero rate years of 2020 and 2021 is now maturing. Those companies borrowed when the RBA cash rate was 0.1%. They are now rolling over into a world where it may reach 5%. The IMF said this week it will downgrade its global growth forecast at next week's spring meetings, citing the Iran war as the trigger. The fund's managing director said that even the most hopeful ceasefire scenario produces slower growth. Australian exporters, particularly farmers, are already facing disrupted fertilizer supply chains from the conflict. Bloomberg reported that global commodity price dislocations are changing what regional producers choose to plant. Small and mid-sized Australian companies that borrowed heavily in 2020 and 2021 face refinancing at rates 2 to 4 percentage points higher than when they took on that debt. The ASX fell 7.8% in March alone. The materials sector lost 14.1%. Energy gained 18.5%. That divergence maps onto exposure to refinancing risk. Capital-intensive miners borrowed during the boom. Energy producers benefit from higher prices. The default cycle Gundlach warns about has not arrived yet, but the conditions are assembling. The resolution scenario is clear: a durable ceasefire, lower oil, and a pivot by the RBA before the refinancing wall hits would contain the damage. But if inflation stays sticky and the RBA hikes twice more before year-end, the credit cycle Gundlach describes becomes Australia's problem too, and the ASX's current recovery would look like relief bought on borrowed time.
Against that backdrop, one Australian company moved in a direction no one else in the mining sector did. Fortescue announced it would fast-track the electrification of its entire Pilbara energy grid, accelerating plans to eliminate diesel entirely. CEO Dino Otranto said the transition would save $155 million in diesel costs and, critically, reduce Fortescue's exposure to the oil market volatility that has reshaped investor calculus since February. That framing is the point worth holding. Fortescue is not only making a green energy move, it is making a geopolitical hedge. The company has also been in negotiations to swap diesel supply with Chinese partners, seeking alternatives during the crisis. Otranto called the mining lobby's push to delay industrial emissions reduction policy ridiculous and disappointing, separating Fortescue sharply from larger miners on both the political and financial question of energy exposure. The divergence within the ASX materials sector this week tells the story precisely. Gold miner Genesis Minerals fell 20% in March when gold prices dropped in the oil shock sell-off, then recovered 10.9% in April. Coal producer Yancoal surged 41.5% in March as power plants switched from gas to coal. Fortescue is structuring its cost base away from the commodity driving the current shock, a distinction that matters if oil stays elevated. The weight of evidence points toward continued volatility rather than a clean recovery.
The ceasefire is contingent on Iran reopening the Strait of Hormuz, and as of Thursday, traffic through the waterway remains restricted. That single condition is the fulcrum. If the strait reopens fully, oil falls, inflation expectations ease, and the May RBA hike may not come. If it stays restricted, the rate cycle continues, the default risk at lack identified grows, and the 4.4% weekly gain gets remembered as a relief rally, not a turn. The number to watch is WTI crude. A sustained move below $90 changes the math. A sustained hold above $95 does not.